Welcome back to Griffonomics, where we conduct financial investigations to define the risk before we look at the reward. Today, we're diving deep into the AI infrastructure debt bomb and the fight for silicon supremacy.
And this isn't just a tech story. It's really, first and foremost, a financial investigation. We're looking at the greatest industrial build-out since, I don't know, maybe the Transcontinental Railroad.
But the scale and the speed are just completely different.
Oh, totally unprecedented. And that scale, it's forcing the world's largest, most cash-rich companies to fundamentally change how they operate, how they even think about money.
Okay, let's unpack this. Because we always think of big tech as having, infinite cash, just bottomless pockets. But what you're saying is we're looking at spending that is moving so fast, it's actually outrunning their own internal cash flow.
That's it, exactly.
And when we talk about scale, we're not talking about a few billion here and there. This is a whole other level of financial magnitude. The latest consensus for big tech capital expenditure CapEx for 2025, it's projected to surge to over $405 billion.
That number right there is the entire story. That $405 billion projection is the core of our whole discussion today.
Right.
The sheer scale of what they have to spend is forcing these platforms, Meta, Alphabet, Amazon, Microsoft, to move, and move dramatically, from their traditional cash-funded cycles
It's just debt.
to heavily debt-funded cycles. And this concentration of spending, this massive capital dump, is creating systemic fragility in very specific parts of the credit market,
Right.
especially because of these complex dependencies, these webs, that are all tied to key players, most notably OpenAI.
So we've moved from a tech revolution funded by profits to an infrastructure arms race fueled by borrowing. That's a fundamentally different risk profile.
It is a completely different risk profile. The financial tail is absolutely 100% starting to wag the technological dog. We really have to get our heads around the magnitude of the commitment before we can even begin to assess the risk of the debt.
Okay, so let's start there. With that massive CapEx number, you said $405 billion for 2025. What was the original projection? What does that huge jump tell us about the conviction level in the C-suites at these companies?
It tells us the conviction is, well, it's nearly unanimous. It's absolute across the entire industry. Earlier in the year, the estimates for 2025 CapEx were closer to, say, $280 billion.
So it jumped from 280 to over 400.
To over $405 billion. That is a massive 31% positive revision in a very, very short amount of time. And what it confirms is that every major player, from the cloud providers to the social media giants, is completely all in on front-loading this AI build-out. As fast as the supply chain will let them, they're just racing to build capacity.
And the spending momentum itself isn't just large, it's accelerating. It's moving faster now than it was at the start of the cycle.
Precisely. That momentum is the critical piece. In the third quarter of this year, total CapEx across the Big Five hit a record $113.4 billion.
For one quarter.
For one quarter. And that represents an astonishing 75% year-over-year growth. That rate, 75%, was actually the strongest single quarter of growth we've seen all year. It suggests that even these elevated numbers we're talking about, they might get revised higher again.
So when you hear someone like NVIDIA's CEO Jensen Huang dismissing bubble fears,
He's doing that while seeing the purchase orders. He's confirming that real, robust demand is forcing this kind of immediate, aggressive build-out. It's like management at Amazon said, right? They don't buy equipment unless they see significant signals of demand already there.
that strong demand signal brings us to the core financial question. If these hyperscalers, the Amazons, the Metas, the Alphabets, if they're such immense cash flow machines, why is debt suddenly so essential? Why can't they just fund this $400 billion build-out with the cash they have on hand?
And that's the counterintuitive part of this whole story. They can't. They simply cannot, because their CapEx growth is structurally outpacing the growth of their internal cash flows.
So even though they generate tremendous cash,
But the rate of investment they need just to stay competitive in AI infrastructure is astronomical. We ran the numbers on their combined financials, and when you look at the required spending, and this is excluding dividends and massive share buybacks, CapEx is hitting these really dangerous structural levels. We project that CapEx will reach 94% of their operating cash flows in 2025.
Wait, 94%. Hold on, let's define that for everyone listening. Operating cash flow, or OCF, is basically the cash a company generates from its core business, before financing or anything else. So what does it mean to be spending 94% of that on CapEx?
It means that Almost every single dollar they earn from their core business, from Google search, from Facebook ads, from Amazon's e-commerce, is being immediately recycled back into building data centers and buying AI chips.
So there's almost nothing left over.
Very little. It means they have very little free cash for flexibility, for unexpected needs, or, and this is crucial, for competitive investment in other areas. It's an 18 percentage point jump just from 2024 levels. And that steep increase is the structural pressure that's pushing even the richest companies on Earth toward external financing. They're exhausting their internal balance sheet capacity just to stay in the game.
And I guess the motivation for tapping the bond market, instead of issuing stock or just slowing down the buybacks, it just comes down to the cost of capital.
Exactly. It's a pure economic decision. The goal of using debt is to access capital at rates that are, typically very low for these investment-grade companies. We're talking in the range of 3 to 5% interest right now.
Which is much cheaper than issuing new stock.
Far cheaper and less dilutive than issuing equity or, halting these massive politically popular share repurchase programs. They need a huge amount of capital committed now, and the investment-grade bond market is still the cheapest, deepest well they can go to.
And this cheap tap has led directly to this hyperscaler borrowing spree we're seeing. How much debt have these giants collectively raised just this year to fuel this AI fire?
So the 5 major hyperscalers, Meta, Alphabet, Amazon, Microsoft, and Oracle, they've collectively raised a record $121 billion in investment-grade debt this year alone.
$121 billion.
And to really underscore the acceleration here, that is more than 4 times the annual average issued by these same companies over the entire prior decade. They aren't just borrowing. They are borrowing at a pace that is fundamentally redefining their financial structures.
Let's just break down the size of some of those recent bond sales, because the market is just absorbing this capital flood at an incredible rate.
The scale of the individual deals is just breathtaking. I mean, in the last few months alone, we've seen these immense offerings hit the market. Meta sold $30 billion in bonds.
$30 billion.
Alphabet sold $25 billion. Oracle, despite all the risk we're about to talk about, they sold $18 billion. And Amazon, most recent one, sold $15 billion in notes. And what's interesting there is that Amazon's deal was initially planned for $12 billion, but it was oversubscribed.
So the appetite is still there for now.
It's still there, even if investors are, maybe getting a little cautious. But that's nearly $90 billion sold recently by just 4 of these major players.
If we connect this to the bigger picture, this has to mean that the credit markets themselves are feeling the weight of all this new supply. What kind of future financial risks are we looking at when you project this out?
The risk really shifts from being about an individual company to being about systemic strain on the entire high-grade corporate bond market itself. JP Morgan, they estimate that the high-grade markets may need to absorb a staggering $1.5 trillion of AI data center bond sales.
Wait, say that again?
$1.5 trillion over the next 5 years.
$1.5 trillion of debt just for AI infrastructure in 5 years. That is a monumental figure. Where is that debt coming from, and why is that number so concerning to market analysts?
It's being issued through a combination of things. You have the traditional corporate notes we just talked about from the hyperscalers, but also, increasingly, these specialized financial instruments that involve securitization. So think data center bonds, or bonds that are backed by long-term cloud contracts, the RPOs.
And the size of that.
The size is the key. That debt used to finance the physical build-out of silicon and infrastructure. It could potentially represent over to 20% of the entire U.S. investment-grade bond market by 2030.
20%. 1/5 of the whole market tied to just one sector. Why is that so alarming?
Because if a single sector AI data centers comes to represent that much of the market, any kind of systemic failure or default or even just rapid technological obsolescence in that one sector, it introduces significant volatility and concentration risk to what is supposed to be the most stable part of the credit market.
So you're hearing concerns from major investors.
Oh, absolutely. Even prominent investors like Jeffrey Gundlach at DoubleLine are getting publicly cautious. They're saying they're on alert about this flood of high-grade issues, largely because the end product, the actual profits from AGI, they're still unproven relative to the cost of the capital being spent.
So while the money is being called productive debt that's fueling growth, the concentration, the speed, and the reliance on a pretty uncertain future profit stream are all variables the credit markets really haven't dealt with before in this combination.
Exactly. The concern isn't that Meta or Alphabet is going to go bankrupt tomorrow. They have rock-solid core businesses. The real concern is the speed of the debt accumulation, the refinancing risk down the line, and the fact that this entire $1.5 trillion system depends on AI models generating enough profit. Analysts think around $650 billion in annual revenue just to justify the CapEx.
And if that revenue is delayed or falls short?
The stability of a substantial portion of the high-grade credit market suddenly comes into question.
We've laid out the massive debt pile and the strain it's putting on the market. But the risk only really comes into focus when we look at who is ultimately dependent on this money. Which brings us to the, let's say, complex funding philosophy of OpenAI. What is their core strategy for their massive world-changing infrastructure needs?
OpenAI has adopted what you can only really describe as a strategy of radical risk transfer. Their core funding philosophy, and this is according to their own senior executives, has been to essentially use other people's balance sheets.
Use other people's balance sheets.
Right. They are the world's most in-demand AI entity, and they are leveraging that demand to convince their partners, be they cloud providers, chip suppliers, or specialized financing firms, to take on the massive debt required to build their infrastructure for them.
And this has been a profoundly successful strategy at displacing the risk from OpenAI itself. The sources we've seen indicate OpenAI has convinced partners to shoulder almost the entire debt burden for its enormous future projects, like the planned Stargate data centers. How big is this partner debt pile that's funding OpenAI's ambition?
It is staggering. OpenAI's partners, and this is a roster that includes huge names like SoftBank and Oracle, but also niche players like CoreWeave, Crusoe, and financing specialists like Blue Owl Capital. They are the ones taking on the debt, in the form of investment-grade notes, syndicated loans, complex credit deals, all to meet their obligations to OpenAI.
And the total?
The total committed debt shouldered by these partners for OpenAI projects is at least $96 billion to $100 billion.
And that's debt committed by partners, not by OpenAI. That is a critical distinction.
It is. And you have to put this in the context of OpenAI's own financials. They have $1.4 trillion in future commitments for energy and compute, a stunning long-term figure. But they only expect about $20 billion in revenue this year.
That's a huge gap.
It's a chasm. HSBC analysts, even assuming massive hockey stick-style growth, are still forecasting that OpenAI faces a staggering $207 billion funding gap through 2030. And that gap between their needs and their profitability is what the partners are taking on the risk to bridge.
Here's where it gets really interesting. A $207 billion funding gap. That is just, it's hard to even comprehend. How could a company expecting $20 billion in revenue possibly bridge that? It forces this complex structure that some analysts are calling a circular funding soup. Can you explain the danger in that arrangement?
The danger is not just the size of the gap, but the self-dependent loops that get created when demand is financed by the supplier. In this AI ecosystem, actors are financing their own customers, which then validates their own demand curves.
Okay, trace that loop for us.
Okay, so let's trace it. NVIDIA, the supplier, they subsidize a neo-cloud provider like CoreWeave with credit or favorable pricing. CoreWeave then issues massive amounts of debt to buy the chips, and that debt is backed by contracts with their customer, OpenAI.
So it all comes back to OpenAI.
It all comes back to OpenAI. If OpenAI's ability to monetize usage, the original source of all this demand, if that slows down or fails to materialize, the demand signal just vanishes. And all that debt-fueled infrastructure sitting underneath is suddenly worthless, even though it's brand new.
That sounds uncomfortably similar to other financial crises we've seen. The analysis draws an analogy to the subprime crisis. Now, wait a second. Isn't calling this a subprime crisis analogy a little alarmist? I mean, these borrowers are Oracle and Alphabet. They're fundamentally sound companies. Is the analogy really about collapse, or is it about concentration risk?
That's an excellent point.
Yeah.
And it's a structural analogy. It's not about the credit quality of the biggest borrowers. No one is predicting the collapse of Alphabet tomorrow.
Okay.
The core mechanism being referenced is the same. Fragility is being masked by complexity and interdependence. In the subprime crisis, you had toxic loans being packaged and sold as high-grade instruments. Here, the debt-fueled AI structure is composed of these tightly intertwined dependencies.
So what's the toxic tranche in this scenario?
The toxic tranche isn't bad housing loans. It is, in the words of one analyst, business models that don't yet generate real profits, and demand curves inflated by actors financing their own customers. A failure in one node like OpenAI not being able to monetize fast enough threatens the entire systemic chain. from the neoclouds all the way up to the major hyperscalers who are exposed to them.
And that brings us to identifying the weak links, which are already showing quantifiable warning signs in the credit markets. Let's start with Oracle's exposure. It seems to be the highest among the big investment-grade players.
Oracle is a textbook example of this kind of counterparty risk. They are heavily committed to the AI build-out, but it's specifically driven by one major client. Analysts have determined that a staggering 2/3 of Oracle's cloud remaining performance obligations, or RPO, is linked directly to OpenAI.
Let's clarify RPO. What does remaining performance obligations mean in simple terms, and why is having 2/3 of it tied to one client so risky?
RPO is just the value of contracted future revenue that you haven't billed for yet. It's your pipeline of secured cloud usage. So if 2/3 of that RPO, your locked-in future revenue, is dependent on one single client, OpenAI, then Oracle's financial stability and its ability to service its own enormous debt load are now fundamentally tied to the success of that one client.
A client who, as you said, is still losing money and facing a huge funding gap.
Exactly. It turns what should be a diversified cloud business into a highly concentrated risk position.
And the market's reaction to this concentration was, well, it was immediate, and you could measure it in the debt insurance market.
It was decisive. Oracle's 5-year credit default swap, or CDS spread, it surged over 100 basis points from earlier this year. A CDS spread is basically the annual cost an investor pays to insure $100 of Oracle's debt against default. So a 100 basis point surge means the market's perception of Oracle's default risk jumped significantly overnight because of this single client reliance.
And what does that spread translate to in terms of implied risk?
If you apply standard market assumptions, specifically a typical 35% recovery rate in a default, that current CDS spread implies an annual default probability of about 1.66%. Now, that's still low compared to speculative debt, but for a company of Oracle's stature, that is a serious, tangible signal of market caution. And on top of that, Oracle has already seen its free cash flow turn negative in 2025 because of its CapEx commitments.
And the fragility gets even more extreme when we move down the food chain to the smaller, more aggressive players, the so-called neo-clouds, like CoreWeave.
Right. CoreWeave, which is a leading specialized AI infrastructure stock, is the absolute epitome of this neo-cloud fragility and high leverage. They've been very successful in raising capital, but their debt load is just enormous. It's at $14 billion in gross debt, $11.5 billion in net debt, and crucially, their CapEx currently stands at 194% of their operating cash flow.
194%.
So for every dollar they earn, they are spending almost $2 on infrastructure. They're relying almost entirely on external financing to exist.
So what is the market saying about their chances of survival?
The market skepticism is intense. CoreWeave's 5-year CDS spread is currently around 675 basis points. Using that same math, that implies an annual default probability of 10.38%.
Over 10%.
That's a clear signal that investors are highly doubtful that CoreWeave can service its massive debt pile, especially since their revenue is so tightly coupled to the fate of OpenAI and its need for specialized NVIDIA capacity. They are operating on a financial razor's edge.
And we saw clear, frankly frightening evidence of contagion risk in the market just recently, proving that this debt problem isn't isolated to just one company. It's a sector-wide vulnerability.
Exactly. When Applied Digital, another one of these niche players, struggled to sell a big chunk of debt, a massive $2.35 billion note offering, the market reaction was instantaneous and brutal across the whole sector.
The stocks of similar companies just tanked.
They tanked. Iron plunged 35%. Mebius fell over 25%, Cypher dropped 30%, and this happened even though these companies appear to have strong fundamentals and multi-year contracts.
Explain the logic of that contagion for the listener. Why does one company failing to sell debt immediately sink all its peers?
It's not just that one company failed. The market suddenly realized that all of these debt-fueled, capital-intensive neoclouds face the exact same inherent risk.
Oh.
What happens when financing conditions tighten up? The market immediately assumes that, one cockroach often means more lurking. Applied Digital struggle signaled that the cost of capital for everyone in this highly leveraged sector might be about to spike.
Which means the financial math underpinning their entire business model might just be instantly invalidated.
Exactly. It proves that any surprise about leverage or financing in this sector triggers instant sector-wide panic. It confirms the intertwined systemic risk of the whole circular funding soup.
Let's shift from the financial plumbing to the actual technology being built with all this debt, because the financial risk is just inextricably tied to the longevity and efficiency of the hardware underneath it all. We're looking at this architectural battle at the heart of AI, the TPU versus the GPU. What are the key contrasts between NVIDIA's and Google's approaches?
This is a classic battle between flexibility and specialization. And it has, frankly, existential implications for NVIDIA's dominance. NVIDIA's flexible GPUs. They're general-purpose parallel processors. They're the workhorse of AI because they can handle a huge array of tasks.
But their biggest advantage isn't the hardware.
No, their biggest competitive advantage is the CUDA software mode, the robust, deep ecosystem of tools and libraries and frameworks. CUDA has provided this software lock-in, which has made GPUs the universal default for training new models.
So NVIDIA won the first phase of the AI race through its software ecosystem and its flexibility.
Absolutely.
Yeah.
Now, Google's tensor processing units, or TPUs, they represent the response to that dominance, and they were really born out of necessity. Google is the ultimate consumer of AI compute, and they decided the cost of using GPUs internally was just too high. So TPUs are the opposite of general purpose. They are highly specialized ASICs, or application-specific integrated circuits.
And what does that specialization actually mean architecturally?
It means they strip away all the architectural baggage that a general-purpose GPU carries around. Things like complex caching mechanisms or branch prediction logic, features that are useless for AI math. Instead, they optimize for one thing, the core job of AI, massive matrix multiplications. And they do this using a unique design called a systolic array.
Can you explain the systolic array design conceptually? What makes it so efficient?
Think of it like a computational assembly line. In a normal chip, you do a calculation, then you have to send the data out to external memory, and then back in for the next step. That process consumes a massive amount of energy and time. A systolic array is designed so that data just flows constantly through the array of processing units inside the chip, without ever having to go back and forth to memory.
So it's an assembly line for matrix math.
It is. It's an internal optimization built to save Google from the sheer cost of running trillions of daily AI queries.
And do we have specific metrics on how much more efficient this design actually is compared to the market standard from NVIDIA?
We do, and the numbers are pretty compelling, especially when you think about the scale Google operates at. For search-like workloads, former Google employees have estimated that TPUs are 60 to 65% more efficient than comparable NVIDIA Hopper chips.
60 to 65%.
And for the right application, the performance per dollar can be 1.4 times better. What's more, Google has shown a really steep pace of improvement. The newest TPU v7 is stated to be 100% better in performance per watt than its predecessor. This massive jump in efficiency and power savings is exactly why Google is vertically integrated.
Historically, the AI focus and NVIDIA's profitability has been on these massive, expensive models being trained. But the sources we're looking at indicate the true economic engine, the real battleground, is shifting rapidly to inference. Can you explain that critical difference?
So training is the process of teaching the model. It's rare, it's a one-time upfront cost, and it demands the most compute power. Inference is the recurrent high-volume process of using the trained model.
So every search result, every recommendation.
Every personalized recommendation, every email spam filter check. Inference is the monetization phase. It's what drives real adoption and recurring revenue, and it is orders of magnitude larger in volume than training.
And the growth potential for inference is just explosive, making it the most important market to control in the long term.
Absolutely. If training is the capital expenditure, inference is the operating expenditure that needs to run 24/7, all over the world. AMD projects that the AI inference market is expected to grow at an incredible 80% compound annual growth rate.
80% CAGR.
Yeah. That staggering scale means that efficiency, which Google's TPUs are built for, is paramount. If you can save 60% on power for every single inference query out of 1 billion queries a day, that is a competitive advantage that just can't be matched by a less specialized processor.
And Google's internal strategy seems to validate this shift in the market.
It does. The massive, highly capable Gemini 3 model. It was trained and powered entirely by its homegrown TPU chips. This proves their technological self-sufficiency and their efficiency at the highest level. Google is optimizing for a future where the marginal AI query has to be cheap, small, and distributed across billions of devices or low-power ASICs. If Google can avoid paying the NVIDIA tax on its own vast internal workload, that cost saving is a permanent strategic moat that no one else has.
So what does this all mean? The rise of efficient custom ASICs, like Google's TPUs, represents a structural long-term threat to NVIDIA's GPU dominance, especially in that high-volume inference workload.
It fundamentally changes the game, and NVIDIA is acutely aware of this. Their aggressive strategy of financing and funding neoclouds like CoreWeave, which we talked about earlier, is fundamentally a defensive posture. They are trying to lock up capacity and usage, making sure the GPU and CUDA stack remains dominant in that high-volume inference market against the growing internal efficiency of the hyperscalers and the threat of custom silicon. They're blurring the line between supplier and customer because they cannot afford to lose that recurring revenue stream.
And on top of that, we've seen reports that Google is willing to start selling its custom silicon to other large customers, like Meta. What are the potential financial implications if Google starts selling chips that are 1.4 times better on performance per dollar?
Well, if Google successfully sells its custom TPUs externally, especially to a major player like Meta who's also spending billions on infrastructure, it would directly capture market share equivalent to a huge chunk of NVIDIA's annual revenue. Even grabbing 10% of NVIDIA's addressable market with a more efficient product would be a financial earthquake. It's a direct erosion of the chip maker's monopoly power, forcing NVIDIA to constantly innovate and compete on cost, not just performance.
And the final piece of this competition puzzle is the asset itself, this infrastructure. It's not like a traditional factory or a piece of real estate. This creates a critical timing risk that's built into the entire debt structure.
And that is the structural threat that makes this debt bomb so precarious. The underlying asset isn't fixed. It's perishable technology. AI architecture requires fundamental re-architecting roughly every 1 to 2 years because of these rapid technological shifts, like the transition from Hopper to Blackwell and soon to the next generation.
So the asset itself becomes obsolete very quickly.
Extremely quickly. This constant relentless cycle means that the asset, the expensive specialized silicon, becomes functionally obsolete. So if you finance that specialized hardware with debt, and that hardware has a useful life of maybe 24 months before it's significantly less efficient than the next generation, the collateral supporting the debt decays faster than in any previous technological boom.
Which raises a terrifying question for the bondholders. If the chips are obsolete in 2 years, how do you value the data center bonds that were issued with 10-year terms?
Exactly. That inherent technological risk is what is so unique to this AI debt structure. The lenders are betting on the future profits of the model being so great that they justify this constant, rapid replacement of the physical collateral, rather than the collateral holding its value over the term of the debt.
Beyond the chip competition and the financial fragility, this enormous infrastructure build-out is granting the U.S. hyperscalers long-term strategic advantages that go far beyond their commercial interests. Let's look at the geopolitical angle first, securing national capability.
Amazon is absolutely leading the charge here, cementing this national security advantage by leveraging its massive infrastructure footprint. Amazon is investing up to $50 billion specifically to build dedicated AI and supercomputing infrastructure for the U.S. government and related defense and intelligence contractors.
And what are the quantifiable metrics of that commitment? Why does this create such a deep moat for Amazon?
The metrics are immense. Amazon is committing to building up to 1.3 gigawatts of dedicated power capacity.
1.3 gigawatts.
That's enough electricity to power roughly 1 million homes. And it's all specifically allocated to high-security government needs. Crucially, this capacity will be available through these highly secured, compartmentalized cloud regions like AWS Top Secret, AWS Secret, and GovCloud regions.
Why is that specialized infrastructure such a powerful, long-term geopolitical moat?
Because it creates a barrier to entry that no smaller player, like a CoreWeave or a mid-level cloud provider, can ever hope to overcome. Government workloads demand specific certifications, physical security, complex compliance layers. It takes decades and billions of dollars to establish that.
So by investing $50 billion now,
By investing $50 billion into securing 1.3 gigawatts of this dedicated, highly specialized power and compute, Amazon effectively locks up the highest value, most sensitive, and non-negotiable compute workloads for the U.S. government. The stated goal from the AWS CEO is that this investment removes the technology barriers and positions America to lead in the AI era, accelerating critical missions like cybersecurity and drug discovery. They're essentially making themselves a utility for national security AI.
moving up to the software layer, let's look at how Microsoft is positioning itself to own the software environment, what some are calling the AI operating system.
Microsoft's strategy. It's not about selling the best model. It's about controlling the distribution layer for what's called agentic AI.
Agentic AI.
Right. That refers to models that are empowered to take actions on their own, with minimal human oversight. Microsoft understands that the real value is in integrating the AI into existing corporate workflows.
So they're not just aiming for an assistant that gives you suggestions, but a digital employee that actually does things within the corporate ecosystem.
Exactly. The strategy is to make these agents behave as actual users of Microsoft products, specifically the Office 365 and Teams ecosystems. Imagine an agent that literally opens an Excel spreadsheet, pulls quarterly sales data, manipulates it, drafts a summary in PowerPoint, writes it back to SharePoint, and then triggers an automated notification in Teams. All without human input.
So by making the agents function like licensed users.
They control the workflow gravity for all AI applications. It's very similar to how Windows dominated the PC world by controlling the operating system.
It's the modern version of that lock-in.
It is. Microsoft is paying for gravitational pull and platform control. This is why Microsoft is willing to absorb multi-billion-dollar paper losses on its OpenAI equity investment. The value isn't just the model's immediate revenue stream. It's controlling the flow of data and work inside the enterprise. If every company uses Copilot agents to manage its workflow, that is an insurmountable moat.
That ecosystem lock-in is vital, but the ultimate, most defensible advantage that the incumbents have is that proprietary data moat. This is something that Google, Meta, and Amazon possess that startups can just never replicate.
This is the non-negotiable structural advantage, the true source of their long-term power. The hyperscalers possess this massive data moat, leveraging billions of daily active users across their platforms. Search YouTube, Android, and Gmail for Google, the family of apps for Meta. This vast daily user base generates continuous proprietary behavioral data.
And it's not just the quantity of data, it's the proprietary nature of the feedback loops.
Correct. When you use Google Search, your click and your subsequent behavior. That's proprietary data that feeds back into the training loops, constantly improving the model's performance. When OpenAI trained its models, it relied on general, less exclusive data sources like public web scrapes and Reddit comments. They cannot access the closed loop of private behavioral data that Google and Meta capture from their billions of users. This creates a constantly improving, self-reinforcing ecosystem that smaller rivals simply cannot replicate, and that secures the incumbent's future market position, regardless of who makes the next best chip.
Finally, let's look at Meta, which is arguably the standout when it comes to the pure financial stress test of this arms race. They're making these enormous commitments, but they lack the foundational, diversified cloud business that Amazon or Microsoft have to fall back on.
Meta is committed to a generational spending spree out of sheer competitive necessity. Its CapEx jumped a massive 111% year-over-year in Q3, and management has already stated that its 2026 CapEx will be notably larger than 2025. They are betting the company on this AI shift.
And the cost is profound.
It's profound because their total expenses are outpacing their revenue growth. This heavy investment resulted in their free cash flow dropping 32% year-over-year in Q3. And that's the metric the market watches, the money left over after essential spending.
So what are analysts projecting?
Analysts are projecting that Meta is risking structurally weak or even negative free cash flow by 2027 or 2028 under its current plans. They are effectively depleting their massive cash reserves to build this infrastructure.
Which highlights the true defensive nature of their investment. They're betting on uncertain future monetization pathways against players that already have multi-billion-dollar high-margin cloud platforms, AWS and Azure, to support their costs.
Exactly. Amazon and Microsoft are paying for their AI race with existing highly profitable cloud revenue streams. Meta is paying for its race by cannibalizing its own free cash flow. This makes Meta's investment the highest stakes gamble among the hyperscalers. It's purely a defensive maneuver to secure relevancy in the next computing paradigm, not an expansion of an existing profit center.
This deep dive has laid out a fascinating and frankly volatile central tension. On one hand, the AI build-out is relentless, the technological promise is immense, and you have confirmation from companies like NVIDIA that robust demand is real and likely irreversible. But on the other hand, the debt structures and the complex dependencies around key players like OpenAI have introduced non-trivial systemic fragility and concentration risks, particularly in what's supposed to be the most stable segment of the credit markets.
And that fragility is compounded by the core nature of the assets being financed, which is a structural concern unlike anything we've really seen before. And this raises a really important question. If the structural fragility is built on debt that finances highly specialized AI hardware like GPUs and ASICs, which becomes technologically obsolete and requires fundamental re-architecting roughly every 1 to 2 years, does the asset supporting the debt decay faster than in any previous technological boom? The vulnerability isn't just the sheer size of the debt. It's the exceptionally short lifespan of the underlying collateral, the silicon itself, that must be constantly replaced just to remain competitive. The investors taking on this debt are betting on perpetual technological replacement financed by perpetual profit growth, a deeply vulnerable dependency.
A sobering thought for the long-term holders of corporate debt. Risk defined, portfolio protected.